Good day! This is Capitalist Domain and we're here to provide you only the best business and financial tips and tricks to live your life to the fullest. Before we proceed to the meaty info, if you haven't subscribed to us yet, click it now and hit that bell button to notify you when we release our new and informative videos. We've said time and time again how crucial investment is if you want money to work for you and eventually have an easier life. We've also reminded you time and time again that it's easier said than done. If you've been a subscriber here for long, then you know that nothing comes easy and everything should be earned by hard work. Today, this video will be about the learnings we get from Competitive Strategy by Michael Porter. We'll give you an edge on how to know if you're investing at the right company. How to look at the telltale signs if the company you're investing in is truly competitive. Today's stock market can be volatile, and it's hard to determine which companies to invest in. One of the most crucial factors to think of isn't how profitable a company is, nor how good the management or its current price is. The crucial factor is to consider how sustainably competitive and advantageous the company is, which will allow it to be profitable in the long term. Here are 5 ways to do so. Number 1. Use Porter's 5 forces. Companies that perform well are constantly under attack from all sides by different competitors, but if they have a sustainable moat, as Warren Buffett would call it, then they can weather out these attacks. The state of competition within an industry is decided by 5 forces, and these are threat of entry, threat of substitution, bargaining power of suppliers, bargaining power of buyers, and intensity of rivalry. The best strategy, according to Porter, is to place your company in a favorable position that will allow it to defend itself or manipulate these forces to its advantage. Number 2. Determine threat of entry. Is the market you're aiming for easy to enter? Think of it as if you're entering a new hobby. If that hobby is easy to get into, requiring less expensive materials, say a ball if you want to try basketball, then that would be more favorable. Compare that with motor racing that requires expensive materials like souped-up car to really get into the hobby. So you'd want to invest in companies where the threat of entry is low. However, there are certain barriers to an industry. If it has high barriers of entry, then an industry is difficult to enter. There are 6 kinds of barriers according to Porter, such as economies of scale, wherein an industry player achieves lower costs in terms of production, marketing, and distribution. This would give newer firms difficulty to enter. Another is product differentiation, wherein longtime industry players with a branding have high customer loyalty, making them difficult to replace. The other 4 are capital requirements, switching costs, government policies, and cost disadvantages. We can discuss these other barriers in a separate video, so be sure to like and subscribe to our channel to keep you updated. Determining these barriers and the threat of entry can help you determine easily which industry to invest in for the long term. YouTube is one such low-threat entry company, but it has so many competitors, so be sure to know what you're going into and find yourself a niche. Number 3. Determine threat of substitution. A substitute product is one that is not part of a main industry providing a particular service or product but fulfills the same need. A perfect example is a landline phone. Landlines are used for making or receiving calls, but a mobile phone could do the same thing and more. Mobile phones are substitute products for landlines, and they can create price ceilings for the telephone industry. There are 2 substitutes to watch out for, which are products that are becoming cheaper with higher performance and those that earn high return of investments on capital. So suppose you've invested in a company already, but its substitute products have released newer and cheaper entries, which would then drive the prices down in your industry. As a wise investor, invest in companies where there is a low threat of substitute, such as the electrical industry, which has no substitute at all. Since electricity is an important commodity, it matters little how it is produced so long as it reaches its consumers. Number 4. Bargaining power of suppliers and buyers. Though these two forces are separate, they can be included in the same vein since they mirror each other. Suppose we have two industries and one of them is the supplier and the other one is the buyer. There will most likely be a power struggle between the two. The supplier can opt to not deliver the product, raise prices, or even lower the quality. On the other hand, the buyer can opt to stop buying the product, demand low prices, or demand higher prices. So, what is the best way to deal with this power struggle? Invest in companies that are winning in this power struggle either against their suppliers and customers. Here are the 6 factors that help an industry mitigate the power of its suppliers. Firstly, if a buying industry holds most of the supplier's sales, then it is in the best interest of the supplier to be friendly. On the other hand, if a supplier has a large portion of the buyer's budget, then the buying industry has an incentive to demand low prices and has more power when it comes to bargaining. Another one is low switching costs, wherein it is relatively cheaper to make the switch from one supplier to another. Yet another is the threat of backward integration, where a buyer can decide to take over the operations from its suppliers by deciding to compete directly. Lastly, the 2 remaining factors are undifferentiated purchases, and if the supplier's products are unimportant for the buyer's quality, then higher prices will never be accepted. Flip the mirror and apply this to the buyer's perspective and you have a way to mitigate or control your buyers. Number 5. Determine intensity of rivalry. How tough is the competition among the firms in the industry you're trying to invest in? When it's tough, companies resort to price cutting, advertising, introducing new products, and increasing customer services, all of which lead to lower profitability for these firms. This means that preferably, you'd want to invest in an industry where the intensity of rivalry is low. So there are factors that lead to low competition. First are concentrated or few companies that are within the industry. These companies already know the ins and outs and recognize their place in the hierarchy, which can lead to better checks and balances within the industry. High industry growth is also a plus since this means that companies can fulfill expansion projects without waging price wars. Another factor is low fixed costs. If there are high fixed costs, this can lead to overproduction and overcapacity, which then gives incentives for firms to sell products at lower prices to cover the fixed costs. This can then lead to low profitability and low returns of investment for the investor. Lastly, high product differentiation is a must for the industry if you want to lower intensity of rivalry. A perfect example of this is the soft drinks industry, where the 2 major players have such strong branding that their consumers perceive their products as different even if they are essentially similar. On the other hand, oil companies have little to no product differentiation at all, hence they have a problem with this factor. With these 5 forces, you can easily determine the returns of the industry you're investing in. Any of these forces are responsible for either a high or low return of investment, or it could be a combination of all the 5. It is imperative that the investor can pinpoint which of these companies can hold out these 5 forces better than the rest. What do you think of these strategies? Do you think you can recognize what company is best to invest in for the long run? Let us know in the comment section. This is Capitalist Domain, and tune in again for the next video's insights on all things business, economics, and finance. Like and subscribe to our channel for more informative content.